Welcome to Morphic Labs, and today we are going to be discussing advanced correlation for markets. More specifically, we're going to be touching on time varying correlation or DCC-GARCH. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. I would greatly appreciate it. And if you're interested in increasing your market intelligence, which if you're into trading or markets in any capacity, you should be interested in increasing your market intelligence. If that sounds like you, I have a free market microstructure and trading systems course that will walk you through the foundations of market structure, the mechanics of trading, market data, and analytics. Plus, if you're interested in looking at markets from different angles, I have a free advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow microstructure aggregation, event-driven hybrid methods, plus implementation and selection criteria so you can pick the most optimal aggregator for your specific use case. If you found that interesting, the links are in the description to sign up to be a free member, and you have both of these resources all to yourself for free. Now let's get into it. Chapter 4, Time Varying Correlation, DCC-GARCH. The Dynamic Conditional Correlation GARCH framework introduced by Engel and refined by Elio, probably butchering those names, I'm sorry if you're watching this, addresses the time-varying nature of financial correlations through a two-step estimation procedure that separates volatility dynamics from correlation dynamics. Let R sub t denote the n by 1 vector of asset returns. The DCC model specifies that R sub t equals H sub t to the 1 over 2 times Z sub t, where H sub t equals D sub t times R sub t times D sub t, where D sub t equals the diagonal of the square root of H sub 1 1 and t up until the square root of H sub n and t contains the conditional standard deviations from univariate GARCH models. And R sub t is the conditional correlation matrix. The correlation dynamics are defined as follows. Q sub t equals 1 over 1 difference alpha difference beta times Q cappy plus alpha times Z sub t difference 1 times the transpose of Z sub t difference 1 plus beta times Q sub t difference 1, where R sub t equals the diagonal of Q sub t to the negative 1 over 2 times Q sub t times the diagonal of Q sub t to the negative 1 over 2, right? The parameters alpha and beta control the sensitivity to recent shocks and the persistence of correlation, respectively. Typical estimates for equity markets yield an alpha approximate to 0.02 and a beta approximate to 0.96, indicating extremely persistent correlation dynamics with slow mean reversion. 4.1. The regime switching alternative. A significant limitation of DCC is its assumption of a single correlation regime. Bilio and Caparon and Palantir, I'm probably butchering those names, I'm sorry if you're watching this, extended the framework to allow for regime switching correlation dynamics, where the correlation process jumps between discrete states governed by a latent Markov chain, right? Where Q sub t equals Q sub S of S sub t, where P of S sub t equals J, assuming S sub t difference 1 equals I equals P sub I and J, where S sub t is an element of the set containing 1 up until K, denotes the latent regime at time t. Hamilton's filter enables efficient likelihood evaluation. Empirical applications typically identify two regimes, a normal regime with moderate correlations and a crisis regime with elevated, rapidly changing correlations. The transition probabilities P sub ij can be interpreted as the probability of moving from regime I to regime J, right? Before we get into market applications and the advantages and disadvantages, I'm going to just show you a quick toy model using random numbers, right? Here's the code. Pause if you want to see what's still going on. But I'm going to essentially, I already ran this, but essentially, as you can see on the random numbers that I chose, right, where essentially we simulated a time series of 1,000 random numbers, right? Or 1,000 by n times. It's essentially a matrix, right? So we take t 1,000, so it's 1,000 by n assets, right? So 1,000 by 3 matrix, but whatever, right? As you can see, our beta for the this chosen random numbers is 0.88, right? And our alpha is 0.0, which is fairly close to the empirical parameters that we saw for equity markets, right? If you recall, the parameters alpha and beta control the sensitivity to recent shocks and the persistence of correlation, respectively. Typical estimates for equity markets yield an alpha of 0.02 and a beta of 0.96, right? So our random numbers essentially are the parameters that were chosen are very close to the equity markets parameters. Not saying that this means anything specifically about the random numbers. All I'm saying is that the beta and the alpha parameters are fairly close to the empirical parameters found for equity markets, right? But there was just a little toy model just to show you, the model applied to random numbers. As you can see, market application regime switching DCC models applied to global equity indexes identify crisis regimes with probability of occurrence increasing 3 to 5 days before major market dislocations. The smooth regime probability serves as a real-time correlation stress indicator for tactical allocation. What are the advantages? Captures time-varying correlations parsimoniously, right? Handles large cross sections n greater than 100. Regime switching detects structural breaks widely available in standard software, right? So Python, Julia, R, whatever you're using, there's most likely a package for that, right? Limitations: assumes conditional multivariate normality. Number 2, regime identification sensitive to specification. Number 3, lagging detection of correlation spikes. Number 4, parameter proliferation in multi-regime models. And that's about it for today. If you found that interesting, hit the subscribe button. I would greatly appreciate your support. And if you're interested in increasing your market intelligence, which if you're into trading or markets in any capacity, you should be interested in increasing your market intelligence. If that sounds like you, I have a free market structure and trading systems course that walk you through the foundations of market structure, the mechanics of trading market data, and analytics. Plus, if you're interested in looking at markets from different angles, of a free advanced market aggregation course that walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow microstructure aggregation, event-driven hybrid method, plus implementation and selection criteria, so you can pick the most optimal aggregator for your specific use case. If you found it interesting, the links are in the description. Just sign up to be a free member, and you get both of these all to yourself. And that's about it for today. I'm out. Bye.